We've got Michael Kurtz, who's Chief Asia Equity Strategist at Nomura. He joins us on the show from Hong Kong. Now, Michael, to begin with, let's start with your perspective on the macroeconomic data we have had globally. Chinese manufacturing has showed a surprise jump in the month of March, contrary to expectations. And on the other hand, the CPI data was within the government limit of 4%. Nevertheless, how real is the possibility of a hard landing in China this year?
We don't think China has substantial risk of a hard landing unless there were an external factor. And by which I mean if Europe does come into a new period of protracted sovereign risk where it begins to impact on the real sector in Europe, and so we see Europe going from what would otherwise be a mild recession into a much deeper and more intractable recession, that could be problematic for China. And certainly if the U.S. were to stumble over into something like a double-dip recession, that would be problematic for China. China does need the help of a relatively robust export sector to help carry their own growth forward. But absent a major rollover in the global economy, we think China is actually on track at this point for growth of just above 8% for the full year. We're looking for 8.2% in 2012.
Now, Michael, on the other hand, as expected, Europe was disappointing in terms of unemployment and manufacturing numbers. How much worse do you think it would get before we see any sort of improvement in the euro area?
There's no doubt about the fact that Europe is and will remain the weak spot in terms of the global outlook well into 2013. Europe's macro numbers are going to continue to look relatively problematic, I think even in core Europe, where the willingness of banks to continue to provide credit is becoming a drag on aggregate demand. And unfortunately, European policymakers really haven't even made the move yet to looking forward and really addressing some of the structural impediments to longer-term growth rates. They're still busy fighting fires right now in terms of addressing the immediate need to stabilize credit markets. And that means that the longer-term growth outlook is still, for the most part, being neglected. All of this, nonetheless, can be eased and mitigated provided that the global economy is continuing to recover. And this is why the outlook for the U.S. and the outlook for China and the rest of Asia is so important even for Europe. If we get a relatively decent U.S. recovery in 2012, as we're expecting at Nomura, of about 2.3% GDP, and if China continues to hum along at something like 8 to 8.2% this year, as we expect, that should keep the recession in Europe relatively mild and provide enough of a boost from the export sector to mitigate the worst of the potential downturn there.
Afternoon, Michael. Now, within the Asian basket, how would India and China compare? Where do you see the markets heading by the calendar year 2012?
China and India certainly are both markets that will tend to do well as long as global investors continue to increase their appetite for risk in the months ahead. That is ultimately what we expect as we look beyond some of these near-term uncertainties and risk factors that are clearly making waves in the equity space at the moment. China and India, both interestingly enough, are markets that offer a degree of value, although China is cheaper relative to its own long-term average PE multiples than India. China about 25% discount, India more like an 8 or 9% discount. Both markets have room for monetary ease in the months ahead, fairly uniquely in the region, because we see most Asian central banks at this point probably done with monetary ease. But both India and China, we think, have some room to cut interest rates in order to provide some support to domestic growth in the months ahead. But if there's another similarity on the negative side, I'd say it's that in both China and India, politics are going to continue to be problematic. China, of course, going into a leadership transition at the Communist Party Congress in October. In India, it's simply very messy and fraught coalition politics, which unfortunately didn't really get much of a boost or much of a change after some of those key state elections that happened earlier this year, particularly in Uttar Pradesh. And that, unfortunately, is going to make it tough for India to really get its policy house completely in order this year. But nonetheless, reviving global growth, discounted markets, and some room for policy ease, both China and India are probably in a position to do relatively well on the balance of 2012.
Okay, but I wanted to focus solely on for the Indian markets. For the next 9 months of 2012, which sectors are you going to be betting on, and where do you think value lies?
In India, we would actually adopt a bit of a straddle in terms of our sector allocation. We do believe that the Reserve Bank has room to bring policy interest rates down, probably by another 75 basis points on the full year. And we are looking for another decline in the mid-April meeting of the RBI. So we do want to be exposed to some of those rate-sensitive sectors. Certainly the banks, arguably property, autos as well as a play on interest rates, and maybe by extension also some of the more investment-driven sectors like cement and steel in India are worth having a look. But then at the same time, we want to keep ourselves somewhat hedged against the possibility of further rupee declines in the months immediately ahead. Q2, in light of some of the global context, may continue to be a choppy quarter for rupee performance. And as a result, we'd want to get some effectively hedge against rupee declines by having exposure in the pharma sector and in the ITEs or IT-enabled services sector as well.
And lastly, Michael, as we kick off the fourth quarter results here in India, what is it that you're expecting?
Unfortunately, there may be some room for disappointment here. If we look at the consensus expectations for growth on the quarter, we see that the consensus is still for about 14% earnings growth in the non-financial space versus 10% in the previous quarter in terms of actual earnings growth. And that suggests that there's some scope for disappointment. I would particularly point to the consumer discretionary names and perhaps in the bank space, in the financial space, also relatively aggressive earnings expectations built into the consensus right now. Whereas at least we can say that the expectations in the materials space and in the industrial space appear to already be very conservative. But overall, it looks to us as if perhaps Indian consensus expectations are still relatively aggressive, and therefore it may prove to be a fairly choppy results season, as some of those numbers arguably are going to come in below those relatively aggressive expectations.
Michael Kurtz, many thanks for coming in on the show and giving us your view on the broader financial markets and also talking to us about what the Nomura view on Indian equities is.